Mayuresh Joshi, Head of Equity Research at William O'Neill, is joining us right now on the show. Mayuresh, stones threw away from record highs. We've seen cyclicals, play their cards well over the last week or so. Metals as a pocket is spruced up. Autos has started to come back in. Consumption too, the likes of Nestle has really, garnered some attention. What would you do right now, and what's the sense around, fresh investing?
Morning, Devina. No, so clearly I think the market's in a state of euphoria. I think that's what clearly is getting displayed in terms of the levels, both at the index end and even the broader market rally. I think a lot of broader market stocks are still languishing. I think where the numbers have been a little bit better and where the expectations in terms of the earnings landscape probably looks a little bit more brighter over the next few quarters. I think the sector stocks are probably reacting to both these elements accordingly. Having said that, when you're probably expected to see in terms of the cyclical movement, I think banks as a pocket have done exceptionally well. For metals, again, I think the resolutions that one really expects to come from the US-China trade war and the belief that at some point of time, realizations on the LME will start picking up. And as both these factors move in tandem, the expectations of leverage playing on the balance sheet and improvement of cash flows emanate on the bottom lines and the earnings is something that the street is hopeful about. But I think the sector still looks a little bit patchy in terms of a few key variables. So the demand-supply dynamics still look a little bit skewed. What you probably expected to see on the input side, input costs have definitely moderated quite a bit, whether you talk about iron ore costs, whether you talk about petcoke costs, so on and so forth. But genuinely, I think for realizations to improve, I think the demand-supply dynamics need to come back. So I think it's more sentimental in nature at this point of time. Consumption, as you rightly pointed out, I think will again largely depend upon how the Rabi season actually fares. So again, the initial take that we probably have in terms of better reservoir levels, good moisture content, will probably ensure that Rabi output is probably far more resilient this time round, which means that Q4 should probably be far better from a rural discretionary spending perspective, though one has to balance out how the rural inflation is panning out at this point of time. So yes, consumption as a pocket can do well. We do like banks from a cyclicality perspective, but one really has to be very, very choosy, specifically where the index is at this point of time.
Mayuresh, the other bit is that while we are seeing what metal stocks are doing individually, and all of them are hitting those highs, and selectively the steel companies are doing that, the others are not. The question is, if the presumption is that this up move could well continue aided by the global markets, would you rather play steel and the cyclicals, or would you stick to the tried and tested? Given a choice between some of the private sector banks which are moving up versus some of the metal names which are moving up, the large caps, where would you place your money on?
So, morning, Neeraj. Again, I think it's a question on how you're trying to position yourself. If you're probably taking a very myopic or a short-term view, as I said, I think metals probably can give you a better move compared to what the banks have done, because the banks have actually given you a stellar move over the past few months and quarters. But what has probably happened and transpired over the last few weeks, and what is probably expected to happen for the sector as a whole, though I think the non-food credit still languishes around 7.98 odd percent, you're still expected to see the private sector guys who have probably delivered better numbers both in terms of advances and the deposit growth as well, continue on this growth trajectory. What this also does in terms of the provisioning that they've actually done on their balance sheets will actually shield them as the write backs also start happening. Similar is the case with a lot of PSU banks with the SR resolution as well. But I think the private guys are better placed from both these elements. So I think the return ratios will definitely improve as the NIMs and spreads and the asset quality also stabilizes over the next few quarters. For metals, Neeraj, as I said, I think input costs have definitely moderated. What you're probably seeing in terms of a play between ferrous and non-ferrous, I think the HRC, CRC prices are still languishing at low levels. What you've also seen in terms of the overall LME pricing, whether it's steel, lead, copper, zinc, aluminium, I think all these prices are at absolutely low levels. Obviously, with the backdrop of the US-China trade war, but a large element here also comes to how the results have been. So the results have been extremely soft for the quarter gone by, and though I think Q3 might show a little bit of more resilience on the input cost front, I think stocks, for example, like Vedanta, I think they clearly got hammered because of lower aluminium prices, what you probably expected to see in terms of the alumina offtake as well, and the other elements in terms of the overall earnings trajectory. The coal inputs also from its mines probably a little bit short than what one really expected. So again, I think as a short-term tactical play, metals can very well be the flavor, but from a medium-term perspective, I think banks is something that we'll still bank upon.
Come to you on Zee, Mayuresh. Now that Subhash Chandra has given up his chair, what's the way forward? I mean, this was something that probably is a result of the stake coming down so drastically to just about 5% odd. But what should one do if they're already invested in Zee versus whether or not they want to take a play on the operational performance going forward and invest right now?
So yeah, I think it's been an obvious move considering the pairing of the shareholding that has probably happened at this point of time. But when you probably look at the two elements, I think one, the operational element in terms of how the numbers have fared and how the entire landscape looks specifically in the media space and how Zee is positioned. And the second element, with new investors coming in, what kind of disruptive changes can you expect to see from a management perspective? So on the first element itself, I think the earnings have largely held up. Now, what you're expected to see in terms of ad growth, I think with the slowdown that we're probably witnessing across sectors, I think there might be some moderation on that front. So largely, I think the street is trying to factor in that maybe a few quarters down the line, I think the normalization on that front will start happening, which replicates in terms of margins normalizing as well, and having a ripple effect in terms of how the bottom line will grow. The second element obviously is the management change thereof and the kind of direction that one can get. But I think there is no hard and fast rule that is probably attached to this. I think being an established player that it is across regional genres that you've probably seen, I think they're trying to establish a good market foothold and that you've probably seen from the subscriber growth as well. So I think not expecting too many disruptive changes coming through from the management side. I think it's just a perspective in terms of how earnings will stack up over the next few quarters. Might be a tad bit soft, at least for the next quarter or two as far as the ad revenues are concerned. But I think the street will start gestating that in and build that in terms of numbers as they roll on 21, 22 numbers for Zee. So I think the business model per se, I think is robust. I think the positioning that it probably has is quite strong. From a price action perspective, I think as per our methodology, I think there is still a little bit of time to go. So I think let it stabilize, let it consolidate. Maybe I think the next few weeks or months, I think you'll get a better entry point into Zee.
Okay. Now, some more stocks that will be in focus. Remember a few days back, we had done a piece on the MSCI changes and the kind of rebalancing and the impact that it will have on flows for specific names. And a lot of stocks would be in focus today. I mean, the large ones like Reliance and some of the others like ICICI Bank, as also mid-sized names like Colgate will all be in focus today. So do watch out. 26th is the day from a lot of these become effective. And mind you, the dedicated funds would essentially put their funds into play only after it becomes effective. Some people would do preemptive buying, but this is largely a list of names which you should focus on the expected estimated inflows as per what the Motilal Oswal note says. Now, a lot of names out here, some of which are expensive, some of which are not. Mayuresh, I want to come to you on two names out there in that list that we just showed. One of them is DLF, which is seeing some consensus upticks in its price targets and is likely to see substantial inflows. The other one is Colgate, which has taken a bit of a beating in the recent past, but could see some buying.
So I think both the elements here, Neeraj, have some issues to address. DLF, for example, I think when you're probably talking about the entire inventory, that probably still stays on the higher side, specifically in the regions that it operates out of. And though there is every hope that there might be some liquidation happening over the next few months and quarters, how the pricing element actually plays out and how the clearing of this inventory actually happens is going to be extremely critical. The second element obviously is how their annuity business actually shapes up. So I think that has held up pretty well for them in the past. But again, I think the kind of expectation that one really has in terms of new additions probably happening, and even the new additions in terms of sales velocity on the residential side of their business, I think that is something to be seen. The second element and the other sphere that you're talking about in terms of Colgate Palmolive, I think the numbers have held up quite okay so far. So what you've probably seen in terms of gross margins, what you've probably seen in terms of EBITDA margins and the market share, both in terms of toothpaste as well as toothbrushes are concerned, I think it did see the those market share had two competitors as well. But I think the Ayurvedic portfolio coming back, the expectations of them actually able to stabilize and maintain their market share at the current juncture, and expectations of gross margins expected to remain around the similar levels. I think those are some things that need to be observed over the next few quarters. No question about their earnings profile. I think the return ratios are fabulous as always. What they're doing in terms of valuation, tad bit on the higher side. But I think it does deliver numbers a tad bit below expectations in the past few quarters. But again, I think it should normalize going forward as well. So the flows are obviously going to benefit both these companies going forward. But if I have to pick and choose, probably consumption as a basket and Colgate as a stock would still be a preferred pick.
Okay, there. Mayuresh, I just want to come to you on some of these housing finance companies. Now, while obviously Indiabulls Housing Finance is on a trip of its own, but it's a very volatile stock nonetheless. It'll be like catching a falling knife. But a stock like LIC Housing Finance too has gradually been moving up and is probably creating that kind of investor wealth as well.
Oh, it is, Devina. And again, I think if one really has to pick and choose between housing finance companies, I think the kind of advances distribution that they probably have, I think the profile that they probably cater to remains extremely critical. Now, for companies like an LIC Housing Finance, I think the retail portion still remains extremely high. Though over the past few quarters, they have ventured into LAP and builder financing as well, where I think there has been some element in terms of asset quality issues actually cropping up. But again, I think that's for the industry as a whole. So yes, I think anybody who has been invested into LIC can very well hold on. But again, I think what we probably like, as I've always mentioned in the past as well, I think Canfin Homes is something where we believe that if one buys over the next few days and weeks, I think let the stock actually make a move of 4 to 5%, because then it will be close to our pivot levels that we're looking at as an exact buy point. I think it looks sufficiently placed both from a supply demand perspective as far as the volumes are concerned. And when you're probably talking about the fundamentals itself, I think the NIM's expected to remain stable going forward. What they've done in terms of reported asset quality numbers, I think that should stabilize around the current figure as well, which basically means that as they're expected to grow their book, and again the ticket size thereof, I think it's pretty reasonable, and the profile to which they lend, I think it probably looks like a pretty reasonable and a decent business and the balance sheet that they're probably carrying over the next few quarters. So yes, I think anybody holding on to LIC can definitely hold on, but for Canfin Homes, I think another 5-6% move exactly close to our pivot points. If that pivot point at the current juncture over 5% is taken off, I think the stock can actually deliver good returns, as earnings can be quite good over the next few quarters.
Okay, now some data, and interestingly, since June 3rd when the Nifty hit the life highs, then only two sectoral indices have actually delivered positive returns, which is financial services and FMCG. Almost everything else, auto, real estate, pharma, IT, and even PSU banks have languished. The key is, can some of these indices make a bit of a comeback? And we'll wait and watch if that happens or no. Some of the stocks in these indices, which are top of the mind, are names like Berger Paints, which again, as per the MSCI rebalancing, might see a bit of an inflow. So do watch out for Berger Paints in the session today. And then because of the weightage increases, we might have some inflows coming in for a stock like ICICI Lombard. So these are two names that are interesting. Now, Mayuresh, fundamentally, I don't know if there is enough valuation backing for a Berger Paints trading at it is at 70-75 times, but ICICI Lombard fundamentally, Mayuresh, is there a case for buying this one?
Oh yes, and we believe so, Neeraj. And again, I think if you probably look at the business argument and the model on which it is based, I think there is huge scope in terms of penetration, specifically in terms of the general insurance products. For most players that are operating out of this area. The second element obviously is the conscious reduction in terms of the crop protection plans that Lombard has done. And now all the general insurance companies did take a hit because of the irregular monsoons that we saw and the claims thereof. So I think the combined ratios for most of these players did shoot up above that 100% kind of a mark. But I think the conscious decisions to probably pare this down and the expectations of motor insurance, both own damage, third party, as well as health insurance. I think these are two spaces that can do extremely well going forward. The third element in terms of their entire distribution network and the bancassurance types that they probably are entailing going forward as well, I think that creates the foothold that is probably required to probably entrench into tier 3, tier 4 cities and towns as well. So I think the earnings should start holding up going forward. What you've seen in terms of the potential for the business to deliver still seems to be pretty large. The private space, and again, I think this is a very niche player thereof, I think it should maintain and in fact keep on gaining market share going forward as well. And that should reflect very, very positively in its earnings going forward as well. So yes, I think we remain extremely positive on ICICI Lombard over a medium and longer term.